Hi DT. So
Hey,
we're
Nick.
back for the. This is the December Horizon Unpacked. It's actually the 12th day of Christmas.
Oh, it is actually. We'll take the decorations down.
Yeah, 12th. Are you big into 12th night?
Not particularly, if I'm brutally honest.
I
Are
think
you out hard
no,
this
I'm not.
year?
I'm not really out hard, but I do think it's important to do the 12 days. I think it's very important. So yeah, we're still we're coming out with the December edition, but it is early January, and probably you possibly know, but I couldn't. You can't take the trader out of the boy because I had to hoover up the 27p mince pies this morning
Oh yeah.
in Tesco, seeking the value. Yeah, that was all very very good. Great. So we have a couple of things to talk about. So the first thing we're talking about really continues on the themes of issuance, because issuance it's been in the press.
Yeah.
Certainly, as we were kind of flagging, as early as September. Now everyone is talking about the amount of issuance that's going on in the convertible bond market. That makes sense. The comparative advantage of convertible bonds over straight debt and getting those interest costs down for people. But we're talking about Scrivener's errors. Convertible bonds have prospectuses that run to pages and pages, 170 to 250 pages, very typical. And in there's lots of scope for screw clauses, in errors that are written in prospectuses and offering circulars that are written correctly, but where they aren't written correctly, it gets even worse. And then you've been doing a bit of work around fund liquidity mismatching.
Yeah. So that's kind of, I suppose, my wheelhouse from the olden days. The funds neck of the woods. Yeah, it's all to do with. It's been a lot of a push. I mean, it's been ongoing for a few years. The issue with open-ended funds that offer maybe daily or monthly liquidity, investing in much less liquid assets. So the problem could be, and we saw it around Brexit in the UK with property funds, we saw it with Woodford also here in the UK, and there's been other mostly property type investments that have seen it over the last 10 years, whereby there's that danger that there's a first mover advantage. If you can get in early to redeem, you sort of end up leaving the remaining investors taking a write down on the assets. You get out for, in inverted commas, NAV, and everybody else will take a hit as those assets then have to be forcibly sold to make good as further people then waterfall down and redeem. And I just think regulators and sort of oversight bodies have been looking at this to try and put in certain mechanisms that may allow people to be treated, inverted commas, more fairly. And part of this is this liquidity management tools, as you mentioned, which we'll come on to later.
Well, I can't wait to talk about that, because I think it's a really really good topic, and as you point out, something that's kind of come out of a lot of years of experience and bad experiences.
Yeah.
And there's also a lot of experience we can draw on from our experience ourselves of trading and unwinding books at difficult times, because it's all similar. Liquidity is key. Great. Well, let's talk about the Scrivener's errors part of Horizon. And the bit like we were saying last month, the point is it's this time of year where you are cranking up the printing presses, so to speak, in terms of getting deals done. And most deals follow a template. People don't. Particularly when you're trying to get a lot of deals out of the door at the same time, you're not going to start looking for innovative things to do. That's what you do in the middle of the year, where you've got a bit of time on your hands. And the tendency can be to just reach for a template, and then overworked, overtired, you aren't correcting the details. And I guess that what's sad about that is you build up this wonderful income stream going into year end, and then of course all of that can be unwound later, maybe not in the months later, but certainly in the years later, when people start poring over the documents, when the music stops and they suddenly realise that actually this clause wasn't written that well, and the what ifs and so on, which are now being tested, mean that people then resort to litigation. So that's the kind of the cautionary tale. And we do, we're talking about an instance, just to really give people the kind of, what an example could look like. It's very easy to say, well, it's, the courts can just make an amendment or get the prospectus or indenture put right. But the reality is, actually, it's much harder than that. And we had a practical situation to work through, nearly 20 years ago now, of course, which feels like a long time ago. But the point is that actually, these things occur over time, and the market kind of forgets them, and it's important to have these lessons from history. So, 20th of December 2004, so in the run up to Christmas, Aristocrat Leisure did bring the whole kind of convertible bond market into a big dispute because they tried to call some bonds where there was a Scrivener's error, and the Scrivener's error was such that Aristocrat Leisure is an Australian listed company, and the Aussie dollar to the US dollar is reverse quoted.
Yeah.
And in the indenture and throughout the indenture, they had got the Aussie and US dollar rate transposed, mixed up.
Mm-hmm.
And so it wasn't really until 3 years into the life of the bond, and also because there was a change in management at Aristocrat Leisure. So the management that had actually done the transaction were no longer in place. There was a new set of managers coming in as a result of a kind of takeover. And they pored over the documents and realised that there was this situation where they could potentially call the bonds, but it relied on the exchange rate being the correct way round. But also the other thing about it was, if you think about issuers' calls for convertible bonds, what are they designed to do? They're designed to force or encourage conversion.
Right.
You're not really out there to try and screw the bondholders. They're your lenders, they're your investors. You want them on your side. But in this situation, there was a particularly draconian clause whereby if Aristocrat called the bonds, then the right to convert was withdrawn from bondholders. That's unusual. Usually what you have is a situation where they can call the bonds, but then there's a period during which all the bondholders can convert should they choose to. And so in this case, when the trustee was approached to say, by Aristocrat, we want to call these bonds, the trustee went, well, hang on a minute, we can't allow this, because if we do this, then we're going to terminate everyone's right to convert.
Right.
And they argued about it for a month between themselves until Aristocrat went, fine, we're going to do it. They delivered this announcement onto the market. There was complete pandemonium because you can imagine liquidity's light. In the secondary market, liquidity is light up to Christmas. 20th of December, you're pretty much there. You're pretty much done. And with it being an Australian bond, I think there were only a couple of Australian bonds, convertible bonds that we were trading at the time. It was another one in Western areas. We weren't particularly active in these names, and that saved us actually, because of course you had people that were very active who hadn't seen the news, and everyone's quoting prices, and of course you soon get the sense that something's up, because at that time of year, for suddenly the bond market to come alive,
to light up that
Aristocrat Leisure and all the bookies quoting Aristocrat Leisure. Was a kind of a strange thing, and there was two things that the market, in inverted commas, hadn't really clocked. That was the exchange rate, and everyone had obviously set these bonds up in their systems, and it's a great sort of thing about human nature, is people will read these things and still make assumptions. They won't query what's in the docs.
Yeah,
they will just set them up, going, no, it must be an error.
The system says this, 0.6. Well, that's actually it's the other one, but anyway, I'll fill it in at 0.6. Yeah. As in, that's not overriding anything.
Yeah. Now parity makes sense.
Yeah.
And so of course that was the sort of first thing that occurred. So missed opportunity there, and then also as is the nature of these things, people weren't aware about how draconian the call was. And so people, were in a panic, attempting to convert bonds that they couldn't necessarily convert. And a long court case ensued, which went on. I mean, the bonds were due to mature in 2006. It went on beyond that. Because when you were trying to work out, because ultimately, to cut a long story short, the court found in favour of the bondholders, but it was a long dispute. Then you had the situation of trying to work out how to make the bondholders good, because when did you do it? What was the date? What was the trigger point at which you determined that that's what bondholders should have received? And it was made further complex because in the convertible bond market, you had people who owned the bonds unhedged or outright. So they were kind of largely unaffected by what happened to the shares. Then you had people who had the bonds and a share short against them because they were getting ready to convert or were trading the volatility. And again, with sort of legal disputes, you don't want to change your position maybe because you don't want to affect your standing or the perception of what you're doing. You're trying to maintain a legal position. That can be costly from a P&L point of view. If you're keeping a short in the shares out, stock price keeps appreciating, which it did in the case of this. So people were sitting on paper losses, paper profits, people trying to make a determination as to where they should mark these bonds. Clearly, you can mark them at par if you thought Aristocrat was money good for it, which they probably were. But then, where should you be marking them at par? Did that say something about your legal position? So it threw up so many complications and questions, all because someone got, didn't clock that the exchange rate was the wrong way round. So I think the kind of the lesson for people is that in the control functions recognise that at this time of year, there's a concentration of issuance. There's a concentration of proliferation of deals, and people are tired. They're going to take their eye off the ball. So errors are likely to increase at this time of year. So have you got any way of looking back and going, look, where are there concentrations of issuance? Should we target our, looking at these areas to see, why I think we're concerned about it this year is 2024, we think, is going to be a year of increased insolvencies. Maybe things will play out okay. I'm not so sure. It feels all right 4th, 5th of January. I think by the time we get through to kind of March, April, and the reality of the year starts to sink in, then you're going to start seeing some of this stuff wash through, some of the stress and the pressure. We already know, there's stress in the Asian markets, and has been for some time. Then when you get these problems, that's when people start poring over the contracts. And it's the fact that you can get a slew of these, bouts of litigation rather than, a steady flow of stuff. It could be a hit for people in one go. So try and get ahead of that now and look around for, where are you going to have those concentrations? What controls have capital market staff got around using transaction documentation that utilizes pre-existing templates? Where you've used external counsel, have they got the responsibility, or what does the contract look like with them? Is it your responsibility? That kind of thing as well. And then if you do have a situation where you can see that there's going to be a dispute, where should the front office be marking this stuff? And also, does it stay with whatever, the loans trading desk? Does it stay with the convertible bond desk? Or should this stuff then get transferred to the distressed desk? And then all of the things that throws up, where, at what level, at what price, what are your procedures? Anyway, so it's all for the want of a horseshoe nail, as the poem used to go. But that's the kind of the cautionary. So anyway, enough on that stuff. Let's have a look at this liquidity stuff.
Yeah, so this was a publication that came out at the end of December from the FSB and IOSCO. I'll quickly look up what IOSCO stands for, the International Organization of Securities Commissions. And as part of the deal, IOSCO has come out with some recommendations regarding liquidity management. And this is what we sort of tried to talk a bit about here today. There's sort of 5 LMTs that they've come up with based of looking at various jurisdictions around the world.
And LMT being?
Sorry, liquidity management tool.
Right.
So this is, as we sort of described at the beginning of the podcast. This is how you deal with the liquidity that you're offering your underlying investments when the underlying assets you're investing in are less liquid. So a classic, as we mentioned, would be property. So, all well and good in a sort of, in inverted commas, normal market. Hopefully, I mean, this is probably maybe more likely to be commercial property, obviously, rather than residential property. But, you can value these things pretty well. There's probably a relatively narrow bid-offer spread in sort of normal market conditions, but obviously in abnormal conditions, that spread can get very large, and there may not even be a bid, and it's just like, well, how do you value that? And there are certain parameters that they've come out with that are ways of trying to amend a single pricing point, which is what a lot of these things will have. You would just deal at NAV on a daily basis or a monthly basis. Now, should there be a spread around that? And the argument they're putting forward is yes, but then it's how does that spread determined? So internally, you may go, well, okay, we need to have this LMT in place to allow people to deal and to be transparent about what would happen if you start to deal. But then you would need to look internally about, well, how is that calculated? Is that calculated in benign markets? The whole point of this, hopefully, is that the LMT is in place at all times, not, oh my God, there's a crisis. Right, well, what you don't want to do, what you're trying to do is, what we've seen in the past is gating of funds, where there's a first mover advantage. Someone tries to hit the bid, as it were, and the fund goes, we don't have the cash to even fulfill that quite small redemption. What do we now do? So they just put up a gate and go, okay, well, we need to either work out, can we, is there a way that we can, let's say, raise some cash to allow some redemptions, or do we have to start fast selling properties to start to fulfill that? In which case, we are probably dealing not at the correct price, because we're having to go out there and hit a distressed bid. So there's, from a control function perspective, really what we're trying to say is this is coming down the pipe, and people will need to have transparency about how they are arriving at that bid offer spread, if that's the way that they're using to have an LMT within the fund, and other things around that. So that's kind of,
and it's an interesting problem, because this comes about because you're offering much better access to liquidity than the underlying assets. That's the fundamental issue. You've also got a situation where in normal market times, you're going to have people joining the fund, people exiting the fund, and it's pretty balanced.
Yep.
It's okay. But it's the point at where you have times of stress where suddenly there's this imbalance. It would be great, I suppose, in a way, to have more people coming in. That's an easier problem to have. But where you have more people coming out, because obviously you can always acquire stuff relatively easy. It's when you're trying to dispose of those assets, create that liquidity. And it's not simply a solution, although you probably could have that solution where you invest in a few sort of shorter term assets. It doesn't really help you, because one, your investors don't, they want to be invested in that asset class. That's why they've chosen it. But also the point you made about, if I'm the first people that kind of clock there's a problem, and the fund starts selling those liquid assets to make me good, then the rest of the holders in the fund are left with the more illiquid, difficult problems in the portfolio.
This is exactly what we saw with the Woodford case, whereby he was butting up against his limit for unlisted securities. And I think that was a UCITS 10% rule, I think it would have been. And as you say, it's the easy liquid stuff that gets sold first, and then you get left. One, you could start to breach rules, because the unlisted part of your portfolio in this case is now breaching limits. So you're forced seller from a regulatory point of view, and you're a forced seller because there's more redemptions coming down the pipe. So you can get yourself into all sorts of trouble there. And also, I suppose, taking a step back, as you say, if you're investing in that asset class, you want it to be invested. So you're in a property fund, there's no point in the property fund holding 60% cash in case there's a run of redemptions, because you're like, well, you're going to massively underperform the benchmark that you're trying to attract, or the asset class that person is invested in, because they're exposed to equities, but they want some property exposure, and this is a nice clean way for them to do it. So it's trying to avoid all of those sort of issues. And don't get me wrong, this is this is not an easy task that is trying to be sorted out.
But I think also it's about clearly. Well, what I see is the transparency. So these LMTs, as you say, they are all reliant on looking at where in an exit situation where the NAV should be calculated and on either side of the spread.
Yeah.
And I think for the control functions, it's really important to really put the question to the people on the front line: how are these being calculated? Can you demonstrate to your investors how these are being calculated? And also think about what scope is there for this stuff to be gamed. What scope is there for people to be perhaps concerned about advantaging themselves? Because the fundamental thing about asset management at the end of the day is it's paid upon the net asset value. Fees are earned on net asset value. So there is an incentivization or a conflict to make sure that the NAV remains as high as possible, because that's the fundamental point at which you're calculating the fees that pay the salaries and the bonuses of the people working in the fund. So that's a conflict that's always got to be there and looked at.
Quite. And also, I suppose you could go if you're an opposition fund to you is being less aggressive or more aggressive with its fees. Therefore, you might find that actually there is an advantage to you being a bit less transparent about what provisions you're taking, because hopefully that will then narrow your spread, which may then attract investors and boost your NAV and assets under management, etc. So absolutely, yeah.
Well, that's a really fascinating topic, one that I think it's absolutely coming over the horizon, and people should be all over and looking at. So Damian, thanks a lot for looking into that and thinking about that. Great, 12th night. We'll get the decks down and we'll get back to normal. We're into the new year, and what a different year it's going to be. We've obviously had all the rate rises in 2023. Where 2024 goes,
it'll be very interesting.
Who can tell? Who can tell? But anyway, don't worry, because one thing you can be sure of: every month, Skadi will be putting out Horizon with arming those people in the control functions and putting them on the front foot with what's coming over the horizon. All right, thanks for listening, and speak to you next month.